Here's a question. When we manage a portfolio, equity portfolio, are we going to put all the capital to securities, or you want to keep some cash reserve, or you can do long or short? Well, it really depends on different situation. All right. So the equity portfolio, it's a portfolio contain all the security plus cash. And in some institution, you're not allowed to do any additional borrowing or short selling. And sometimes you don't have enough cash reserve, but you have a lot of cost there. You have to pay the fee. So here's the question is, how do we generate some income, all right, cash income that able for us to pay the fee or other costs involved with that portfolio? Okay. Now, let's talk about how do we generate additional income, which means that it's going to provide us some liquidity. All right, because when we put all the capital into security and to maintain your uh, the long-term return, you're not able to just change that and sell that security and convert to cash. You could have a different kind of rebalance, but it's very difficult to sell the security convert to cash. So we need to generate income because we got a lot of fee have and costs have to pay. So how do we generate that? First one is that we could generate cash from the dividend, right? Cash dividends. So the dividend income is pretty obvious. However, when we talk about dividend income, then it's going to associate with tax. Now, usually the income tax is higher than the capital gain tax. So for some of the portfolio, you have to be aware that the client may have the tax exposure. But for other type of fund like the 401k pension fund or some tax defer or tax exempt institution like university foundation or some trust fund, then you don't have to worry about it. So dividend could be a very useful way to generate additional income. Now, how do you catch dividend? All right, so this is called here we talk. I put in here is called dividend capture. You think about that. All right, there's one called ex-dividend date. So-called ex-dividend day is that on that day, all the if you buy the stock at that ex-dividend day, then you don't have a right to receive dividend. Okay, and the ex-dividend day is one to cut off whether you have a right to receive dividend or not. So usually, if you can buy that stocks right before the ex-dividend date, all right. Sometimes you can use ETF. For example, you can purchase the S&P 500 ETF called Spider SPY. If you can check out the ex-dividend day and you purchase that one before the ex-dividend day and you hold the stock through the ex-dividend day and then sell that right after. Usually you keep 1 or 2 days after that you sell it. Okay, now it sounds good, all right, but the question is that how do you have enough money to buy, or you can use margin to buy, but anyway, what about if after you buy and the market crash? So this is a risk, right? If you want to play the dividend capture. So the best way probably is to, when you do the asset allocation in your equity portfolio, you could allocate some of the high dividend yield or high yield equity in your portfolio. That way, you're not going to have exposure for the market risk. Another one is called interesting one. I like you everybody pay attention to here. It's a security lending. Security lending is this. Now, if a large fund usually have maybe even $1 billion asset, they buy and hold. So those security, they able to do is to lend it the security to the broker dealer, and the broker dealer actually, right, use the security and lend it to the short seller, because short seller is the one to borrow the share and sell, and then you are the one lend the share to them, but guaranteed by the middleman, the broker dealers. So that way, then when they do the short sale, and you still have the ownership of the all the security, they got to pay you back because it's guaranteed by the broker dealer. Then the good way is that you're going to receive the interest back. So that is interesting, all right. And then even today's for many ETF, like the index ETF like Spider, they have $1 billion there, a couple of 100 billion sometimes, and there's a huge amount of security sitting there. They could lend it out and receive very significant amount interest back as income. All right, so this is another interesting one. The other one is using the derivatives. All right, it's called cover put, meaning that now this is relatively risky. All right, I mean, same thing with the dividend capture. You're going to have a huge impact on the market if the market against you. So if you want to use the cover put or a cash cover put, you better do a good job in market timing. So this is really timing the market. Now suppose you believe that the market will continuously goes up, right? And then you can do here is you short the put. All right, you short put. Now remember the put option, the right to sell, that because the stock keep going up, and then there's nobody actually will sell that put, will exercise the put because the price did not go down to the below the exercise price. Therefore, you will receive the premium. All right, you will receive the premium, and that premium is a cash. All right, it's a cash. All right, so the cash that way that you can use to do your fee payment. So that is using the cover put, which is sell the put. You can also sell the call option, and you sell the call option if you believe the stop is not going up. Instead of that, it's going down. So that way you can receive the premium from the call. All right. And again, to do it on one side is very, very dangerous unless you have ability to predict the market direction. And I personally strongly recommend don't do that, right? Because nobody actually can time the market, especially during a very volatile period of time. Well, let's talk about cost. What kind of costs will involve in terms management and portfolio. The portfolio managers is going to receive the fee based on the AUM, called asset under management, right? And usually is a percentage on that. Sometimes is, for example, 65 basis point, 0.65% of the value. So that is a fee. But that fee usually is an income to the manager, but it's a fee paid by the investor. So we classify that as the cost to the investor. Now another one is a performance fee. Performance fee is that, all right, to provide incentive for manager to outperform the objective. It's an incentive program. So usually we'll set up some kind of extra fee or a benefit to the manager if the return of the portfolio exceeds certain level. Say for example, the fund manager will get the 5% out of anything about 20% return. So that is called the performance incentive fee. And then this fee usually required by a lot of hedge fund, especially they have a long short portfolio, because long short portfolio usually have in terms of percentage return is much higher. So that's the reason they want to use that one to catch up anything about certain level. And the fee, I view, is not fair because the fee is often one side. It's one side. The manager shares in the outperformance, but does not penalize them for the underperformance. So it's only one side. So if you are below that one, there's no penalty. And then here, pay attention to this one called high watermark. And this is the one, for example, that if we have a manager, a hedge fund, they earn the performance fee for outperformance, its return objective. They already earned it, all right? And then the portfolio value decline. Then this time, we will require that manager can only earn incentive fee in the future about the previous level. That previous level is called the high water level, right? So if you earn say 20%, you already earn that one. The next one you have to earn more than that, maybe the 22 or 23% about. All right, so this is the high water mark requirement. Administration fee, and you're able to just take a look at that one. There is server administration fee, marketing fee. That's pretty straightforward. Now I would like to spend a little bit of time talking about trading cost. Trading cost, we have three types impact there. This is important for us, especially during the rebalance period time. First, when you rebalance, you have to sell something and you have to buy some security. The big and X spread, right, will actually cost you a lot of money. For example, you have to buy at the higher cost, which is X price, and then you have to sell that one in the dealer's bid price, which is lower. If the big X and X spread is high, so when you sell someone and you sell at a lower, and you have to buy another one with a higher price, you think about back and forth. There is another very significant differences when the price you want to sell and buy. So that is the BX spread transaction cost. Another one is the market impact. The market impact is this, is that the price is moving fast. Okay, moving fast. So when you want to sell at a certain price, you set an order there, and then suddenly against you, then you change to a market order, for example, and then huge amount of market impact to you, then you may have a loss. Let me just specify. Suppose you want to sell the stock, limit order is $26, $260, say $26 a share, and then it hit at $25.90 and never go back to $26. Right. So, but now you got to sell it, and $25 now dropped to 25.9, dropped to 25.8, and then you got to sell at 25.8 with a market order. Then you have that loss of 20 cents per share. That will be a very significant amount from the market impact. Another one is a delay cost. Delay cost is we call slip page. All right. It really, this happen all the time in the smaller cap stocks, because those stocks is lacking of liquidity. Okay, so so there's inability to complete the desired trade immediately because the order size or the lack of market liquidity. Maybe because this order is too small or the order is too big. All right, if it's too big, there's not enough buyer. If you want to sell the big order and then you don't, and then that's the reason you can have a delay cost. Once you get a delay cost and the market situation change, then you may not get the price you want. This we call slip page. Strategic cost, the last one. All right, this is implicit cost. Strategic cost is this. Well, for example, like a momentum strategy, okay, or the contrarian. The momentum and contrarian strategy is to catch up. The winner is called momentum. The winner become a loser, the loser become a winner, is called contrarian. So that means that you have to involve much more frequent rebalance to catch up either the loser or either the winner. And then these kind of frequent transaction to rebalance, it demand a lot of good liquidity. Okay, liquidity meaning it is a high demand, all right, on the liquidity, meaning that you can sell the price sell the security quickly and get a price you want, or you can buy the security faster based on your desired payment for the security. But unfortunately, if you got a momentum contrarian strategy with outside as a Standard & Poor's 500 stocks, and you're going to involve a huge amount, this is called the strategic cost, because lacking of liquidity.